Hi, my name is Maria Pearman. I'm a CPA with an expertise in beverage alcohol, and today we'll be talking about preparing for year end. Year end is the time between the end of the year, December 31st, and basically wrapping up your books and getting it to your accountant, which let's call that February. So, those 2 months at the end of the year can be incredibly hectic for both businesses and for accountants with whom the businesses work, your tax preparers. So we'll cover a few strategies that can help streamline that process, hopefully take away some of the headache of this time of year, and give you an edge on a smooth process when it comes to tax preparation and some of the other elements of year-end compliance. So we'll cover accounting housekeeping, tax strategy, and then some details around 1099s and W-2s. First, let's talk about accounting housekeeping. When you get to the end of the year and you deliver your financials to the tax preparer, one of the first things that person will check is whether retained earnings rolls from year to year. So rolling retained earnings means that if I look at the retained earnings from 12/31 of the year prior to the retained earnings I have on the book on this year, I can clearly see that if I take prior year retained earnings plus or minus the current year income or loss, that should equal the end of year retained earnings. Sounds simple, and it is in theory, but in practice what we often see is that the beginning of year balance does not match what was reported on the prior year tax return. Most often this comes into play because a company has booked a transaction with a date in their accounting file that was prior to the end of last year. Anytime that happens, it will throw off the retained earnings balance. And, if it's a small dollar amount, the tax accountant will usually just push that through as an adjustment to the current year. But if it's a significant dollar amount, they may ask you to consider an amended return. So, to the best of your ability, close the books. Before you send to your tax preparer, make sure there are no other changes that you're going to have in the prior year, and that will avoid a lot of headache when it comes to tax preparation for the next year. Another housekeeping point is to review all open transactions. These are things like sales orders, it could be purchase orders, so making sure that those are taken care of, looking at your accounts receivable and accounts payable, making sure that anything that truly is open should be open. A lot of times there's some cleanup that needs to happen. Also looking at your reconciliation reports for all of your bank and credit card statements to make sure there are no duplicate entries in there. All of these components need to be addressed. Take care of those open items before sending your transactions and your financial reports onto your CPA for tax preparation. The second point is tax strategy. If you have a company that's profitable in the year, and if you are issuing K-1s to members, then those members will be allocated income. This income is going to be reported on their individual tax return, and they may be in the position of having to pay tax because of the income from their investment, in other words, from your company. Most companies have a provision in their operating agreement that allows for tax distributions. And this is important because you are issuing checks to the partners to cover any tax burden that may arise from what was allocated to them on the K-1. Now, the importance here is that usually you're going to issue those tax distributions, say April, sometime in there, March, April. For most folks, that's a low time of year in terms of sales, in terms of cash flow. This is usually a time of year where we are collecting our cash and saving it, trying to minimize our cash outflow. So if you are back in November, December, and you can tell that you will have profit this year, start planning on how you're going to cover those tax distributions when you get to the spring, because if you end up having to cut massive amount of checks and then the lowest point of the year, that can be really problematic. The third point we'll cover is 1099s and W-2s. Who gets a 1099? These are service providers who are non-corporations and to whom you have paid $600 or more over the course of the year. Those 1099s are due to recipients by January 31st. There are a lot of preliminary steps you can do earlier in the year to make sure that you have W-9s for all of your vendors, that you have updated addresses for all of your vendors. making the work once you get into January a little more streamlined. And then on the W-2 side of things, if you have a payroll provider, that provider will take care of completing and filing those forms and payroll tax returns. However, if you are an S corporation, there are certain adjustments for fringe benefits for 2% or greater shareholders of the company. These type of fringe benefits need to be reported on the W-2 of the shareholder, whereas if a non-owner employee were to receive the same benefit, it would not be required to be on the W-2. So these can be things like the personal use of company car or the value of life insurance. So make sure that you're taking these into account and talk to your payroll provider to get that addressed before year end. Hopefully these tips will make year end a little cleaner, a little smoother, and reduce the stress. I'm Maria Pearman. I'm with GHJ in Los Angeles. Please reach out if you have any questions.